Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Markets rebound. Asian stocks are higher, but US futures in the red, despite encouraging data out of the US and China. The Fed's Tom Barkin says the central bank has time to wait before acting more forcefully. Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy. He and Kamala Harris agreed to debate in September. And oil set to close the week higher as the US, Qatar and Egypt call for a new round of ceasefire talks between Israel and Hamas. So after a solid day for US equities yesterday, a bit of caution seeping into the equities space when it comes to Europe and the US as well. Again, for the context, the Nasdaq ending up with its best day since around November of 2022. In terms of the S&P, I should say, the Nasdaq adding around 3% and the S&P having that best day since the end of 2022. European futures, though, pointing a little bit more muted, just soft gains coming through of around 0.1%, setting you up for a very modestly positive session this Friday here in Europe. The FTSE 100 looking to add just 7 points. S&P futures currently pointing lower by 0.3% after the gains that came through yesterday. Nasdaq futures also looking maybe a little bit of profit taking after that 3% rally on Thursday, looking to drop around 66 points so far. Let's flip the board and look cross-asset. You had a bit of a more muted Treasury auction as well in terms of the 30-year and the reception that investors gave that. But the jobless claims numbers were what fueled the equity gains and the sell-off in the bond markets. Treasuries a little bit more balanced, a little bit more flat in the session today. But again, the jobless claims coming in slightly lower than expected, and that gave that optimism in terms of the equity moves yesterday. The 2-year just above 4% so far in the session. The Japanese yen remains, of course, in focus at 146. Brent, $79 a barrel, currently just up 0.1%. And Bitcoin rallying as well after the drop of 10% on Monday, picking up steam yesterday and above 60,000, gaining 2% in the session today. Let's cross over to Singapore now, where Avril Hong is standing by for a deep dive on the Asian markets this Friday. Avril.
Yeah, Tom, we are seeing how fragile the rebound in Asian stocks can be because the gauge of stocks, as you see there on your screens, is green. And this is underpinned by the gains in the chip stocks, thanks to what we saw in the U.S. counterparts overnight. But they're still heading for weekly losses based on what we're seeing on the MSCI Asia Pacific on the Japanese equity gauges. The Nikkei, for example, clocked gains of 2.4% earlier in the session. Look at where it is now. Very fragile, this rebound that we're seeing. Yes, we did get some of the optimism from the U.S. initial jobless claims easing, recession fears, and perhaps also prompting traders to pare back some of the aggressive easing bets from the Fed. But we also have a lot of data to get through out of the U.S. next week, and then the Fed speak to actually digest. On the Chinese data front, CPI number better than expected, but the core print actually fell, and the headline CPI is still 0.5%, still relatively weak. So this is all being digested for the markets on a day where we are going into a long weekend in Japan. Let's flip the board and take a closer look at what we're seeing on dollar yen. Earlier in the day, it actually hit 147.7 week levels, and we are still expecting a weekly loss for the Japanese currency. This would be the first since late June, but it has actually clawed back some of those declines, firming up now. And there are those that think that the yen is still cheap. There is more unwind of the carry trade to go. BNY thinks in time to come we could see 100 versus the greenback on the yen. Now we're also seeing on dollar China that convergence of offshore onshore towards the 716 level. What was interesting today was the yuan fix again above 714, a week fix. This is something we haven't seen since November 2023. So the signals might be that the Chinese authorities don't want too strong a Chinese currency with the economy in the state that it's in. Let's flip the board again and take a closer look at what we're seeing out of Chinese bonds, because the expectations of policy easing and the doldrums that the stock market is in is really what's been fueling the Chinese bond rally in the past year. And we are seeing some expectations that that could continue. Authorities are now stepping in, ramping up the bond rally fight. This is why you're seeing a lot of red on the screen across the curve in China today. Tom.
Avril Hong in Singapore with a check on the Asian markets. We'll get more details on that China story right now. Avril, thank you, because Chinese stocks, as Avril was saying, rising briefly, and now they're currently flat on the CSI 300 after the official data showed that inflation did increase more than expected. Consumer prices rising 0.5% last month from a year earlier. But investors are still concerned about sluggish demand in the world's second largest economy. Bloomberg executive editor John Liu joins me from Beijing for the latest then. John, thanks for joining us. What does this data tell us then about the current state of China's economy?
So I think on first glance, Tom, the number looked quite positive, rising consumer prices more than expected. But when you dig into it, you realize that the main thing causing that rise was food prices. And the main thing driving food prices was the weather. We had a lot of rain. We had extraordinarily high heat in much of the country in July. That led to food prices rising for the first month this year since January. And that was what pushed up inflation. And if you looked, things like cars, things like home appliances, things like mobile phones, prices for those things continued to drop. And if you looked at PPI, producer prices, that again continued to drop for almost 2 years in a row. And so I think it's still, this data characterizes this economy as being one with very little demand and one in which companies, businesses have very weak pricing power.
So, John, what's your understanding then of how policymakers are likely to respond to that continued challenge around the demand picture for Chinese consumers?
Well, I think we're going to get more action from the PBOC. We had an interest rate cut earlier already. We're looking out for things like a reduction in the reserve requirement for banks. We're looking out for maybe an additional interest rate cut as well. And we're also expecting more fiscal policy measures. The State Council earlier this month put out a plan that included 20 steps to help increase consumption in China. What that plan didn't have, though, was much detail in terms of what those measures would include, and it did not say how the government was going to fund those steps. And so we're looking for more when it comes to those fine details.
Yeah, on the details then front, John, because we've had the rhetoric, we've had the messaging from policymakers in Beijing, we've had the implementation of some measures as well, but so far it seems it hasn't worked, at least to the extent that many would have hoped. What is the assessment as to whether the next steps will make a difference, will move the needle?
I think if the government is going to if it's going to do the things that we're expecting it to do, I don't think in the short term it will move the needle that much. In the longer term, I think there's a possibility that China, the government is selling a lot of debt at the moment. It's sort of stocking up its fiscal firepower. There have been additional calls by economists here in China for the government to hand out coupons, so almost directly giving money to the consumer. If Beijing does do something like that, then in the longer term, you could see a turnaround. You could see people starting to feel a little bit more confident and starting to open up their wallets.
OK, Bloomberg executive editor John Liu in Beijing with the assessment in terms of the data that's come through, the important data on China in terms of inflation and the next steps then, possible next steps for these policymakers in, of course, the Chinese capital. John, thank you very much indeed, our executive editor for China. Now, following a week of roller coaster trading, stocks are rebounding, at least to some extent, after signs of resilience in the US labour market ease concerns about a recession. They certainly rebounded in the session yesterday. Richmond Fed President Tom Barkin says the central bank still has time to assess whether the US economy is normalising before it needs to act.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, in a steady, deliberate way, normalize rates, and stick the landing, if I could use another balance beam analogy. Or, is this one where you really do have to lean into it?
OK, that's been point. Let's bring in Bloomberg's Mary Nicola to break this down for us. Mary, we've had a bit of Fed speak then certainly pushing back on the idea that we're going to get an emergency cut from the Federal Reserve. Then, of course, the jobless claims coming in low and below what we'd expected and certainly below the previous week's numbers. Where do we stand in terms of the assessment on the health of this US economy and expectations about the Fed's next steps?
The reality is that we still don't have enough data. So the non-farm payroll that came through that showed the uptick in unemployment rate was just 1 month of data, which is not enough for the Fed to even start considering a 50 basis point cut or any sort of aggressive easing just yet. Remember, the Fed always looks at some sort of trend in the data rather than just one data point, because you can get aberrations like we've seen in the past. So the fact remains is that we still need to see more data to assess the economy. It's not falling off a cliff, as the weekly jobless claims suggested, but really it will depend on next week, and next week with the retail sales data and the CPI. Because remember, we're all concerned about a recession, and we've seemed to have forgotten CPI and whether that genie is back in the bottle.
OK, so we look ahead to that important data out of the US next week to give a bit more clarity. As you say, retail sales and inflation, and whether or not that disinflation trend continues. We've had a couple of important auctions in terms of Treasury debt this week in the US, 10-year and 30-year, and not particularly well received by this market. How much should we read into that and what it tells us about potentially longer-term concern about the ability of these markets to absorb that issuance?
I think the main thing here, especially with the Treasury market over the past few months, is that we've had such a strong run, and then of course when we want to see confirmation of the Fed coming through and the Fed actually easing, then we could see further gains in the Treasury markets. But I think for now the real concern is that what's happening with the Fed and where Treasuries are heading, and of course Treasuries are still capturing that bid from the risk-off sentiment, whether it's coming from the concern over equity markets, the concerns over a recession, or even geopolitical tensions. So they are still working as, let's say, a haven bid in light, especially similarly to the Swiss franc or the Japanese yen or even the dollar, like we've seen over the past month or so. So the key thing here with what we're seeing in Treasuries is that it could be a lot of the times, especially with how much they've rallied, is that investors may be locking in some of those gains.
OK, Mary Nicola from our MLive team with an excellent take there in terms of the jobless claims, the impact that we saw across the markets yesterday, and how, of course, investors are absorbing this issuance in terms of the debt around US Treasuries. Currently, the 10-year, by the way, at 3.96, yields just down 2 basis points. The 2-year remains just above 4%. In terms of the front end. Coming up, the Bank of Japan is accused of sending mixed signals on future rate hikes. We're going to get details on what we've learned about the positioning of the BOJ this week. That's coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the BOJ is being criticised for sending mixed signals after the Deputy Chief said on Wednesday that rate hikes are off the table for now. In contrast, just last week, Governor Ueda, of course, said rates were likely to keep rising. Bloomberg FX and rates reporter Michael Wilson joins me from Sydney for a take on this. So, Mike, JP Morgan, of course, putting out a note earlier this week saying and estimating that 75% of that global carry trade has now been unwound. Where do we stand on that front? How vulnerable are global markets still to the unwind in the global carry trade? And, of course, the linkages to what we've been hearing from this BOJ.
Hi, Tom. We just put out a story literally in the last half an hour that Bank of New York Mellon think that there's a lot more to do. It depends on all the in-house modelling and everything like that. But I think what we saw this week was 75%. It's sort of like passes the sniff test a little bit, but there was an element of capitulation there. And we didn't spend too much time under that 144 level, and we came back quite well, which makes one think that there were some people coming out and like re-establishing short yen positions already. And the way we've had the dollar yen recover this week, the BOJ governor, deputy governor, they've probably complicated the mix a little bit. I do think that there is a bit of a yin and yang up the top there. I think Cheetah was probably brought in to add a bit of balance to the equation. And U.A.A having set such a strong tone on July 31st, just on the back of that weak non-farm payrolls out of the States. You had these positions, these carry trade positions that have been in place, for years, some of them, but they have been marked to market at more, recent market levels. So that's how you get the snowball effect, and the exit, everyone heads for the exit straight away, and those with either deeper pockets or a bigger risk appetite held on, and that's the 25% that probably JP Morgan's talking about. But back in New York, I think there's more in this. And the market has stabilised a little bit in line with the Japan-US 10-year JGB spread, which itself capitulated through 300 points, got down to about 285, and that's when dollar yen was actually at its lows. But that's recovered now back to about 314 basis points difference, and I think markets will be probably looking at that as some sort of rough guide. We've dropped, I think, 12.5% from the 161.95 high down to the 140.170 low. So I think if people are looking to re-establish longs and get themselves long, there's been reports that the market's actually got itself, the short-term market's got itself long yen already, which I can't really agree with entirely yet. But I think people will be trying to fade somewhere halfway around the middle of that, which is around the 150, 180 level. So if we do see some extension, some decent US data come out, we might get a chance to do that. But for now, we're still finding our feet. But I do think that 140, 170 will probably hold maybe for the rest of next week, but it's still very choppy in the middle.
Okay. So, Mike, you talk about the importance of the US data, and that, of course, ties us to thinking about where the Fed goes next, and markets are fully pricing in at least 25 basis points by September. How constrained is this Bank of Japan by the Fed's next steps, and what does that tell us about where the BOJ goes from here?
Well, I think that the BOJ summary of opinions gave us a little bit of insight there. I mean, the divergence between these two central banks, there's calls of 50 basis point cuts, sense of urgency over at the Fed, well, not the Fed, but US banks. And then you've got BOJ says, yes, we're going to hike, but, it's going to be incrementally and there's no rush to do so. But at the same time, within the BOJ, if you look at one component at a time, I do think that they are laying the groundwork for the next hike, which is not until September 20, by the way, if it does come then. And there's a lot of data to go under the water, under the bridge then. But if they do it, I think that you'll see that U.A.A will make strong arguments along the way with a bit of guidance to not disrupt the market too much. He's seen what can happen, and he's seen the commentary around that. Whereas with the Fed, the markets have, when Powell talked about putting September on the table, the markets have just run with that immediately, and now they're talking, 50 basis points. And I think what the Fed's worried about is not starting this. Once they start, they can't start and stop. They've got to keep going. So they really want to make sure, like Mary Nicholas said earlier, that the inflation journey's in the bottle. And that comes next week with a bit of guidance. So I do think that number will be looked at a lot. Okay. And once we get sort of confirmation there, that 50 basis points will become more of a done deal, and then we'll look at subsequent cuts from there. And that speaks to maybe a dollar yen, maybe having another go at that 140 level on the way through, as more carry trades are flushed out. And we haven't even started talking yet about repatriation when Japanese funds start to bring their money home. And I think that'll be the next wave, more like a tsunami when that happens.
Well, that's something to be thinking about then, isn't it? That tsunami of repatriated funds. Bloomberg's FX and rates reporter Mike Wilson with the details, the context in terms of what has been a pretty momentous week, of course, for the BOJ and its role in this global financial system. Mike, thank you very much indeed. To other stories making the news this Friday, we've learned that Barclays has become the latest bank to remove an EU-era limit on some of its top bankers' and traders' bonuses. An internal memo seen by Bloomberg shows the company's so-called material risk takers can now earn bonuses of up to 10 times their base salary. Goldman Sachs, JP Morgan made similar moves earlier this year. Coming up, Europe braces for the end of its reliance on Russian gas supplies. But is the continent prepared, and how will it impact prices? We take a closer look next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday. Now, while a lot of people are still thinking about their summer holidays, gas traders, they're already looking ahead, of course, to the winter. One of the risks they are keeping an eye on is Russian pipeline flows via Ukraine being potentially cut off. Here to tell us more, bring us more details, is Irina Sereda, head of Bloomberg NEF's European gas team. Really well placed to walk through this story with us and give us the details as to what is transpiring. Is there a chance then that those flows stop, and what could the impact be?
In our view, it is unlikely that Russian gas will continue flowing through Ukraine after 2024, as it's not only the transit deal that is expiring, it is also the technical interconnection agreement between Ukrainian transmission operator and Gazprom. So for any gas to continue flowing across Russia-Ukraine border after 2024, that interconnection would have to be renewed. Now, Ukrainian TSO had made it clear that they have no intentions or negotiating with Russia the extension. So for any gas to continue flowing, that the interconnection agreement would have to be renewed. Also, with no renewal in sight, European companies that are still relying on this route have made steps to diversify their supply. So, for example, Austria and Slovakia, they signed deals with other gas exporters and booked necessary transportation capacity for the next year.
OK, so the contingencies are being put in place already on expectations that this flow will ultimately cease. Are there other sources of gas that could come to Europe via Ukraine? There have been talks maybe Azerbaijan could be one source. How likely is that?
Yeah, according to Ukraine's president, Azerbaijan could be one of the options. However, it poses multiple questions. So one of the options could be a swap arrangement in which Russian gas labeled as Azeri gas could be sent to Russia-Ukraine border. And then Azeri gas labeled as Russian gas would be sent to Azerbaijani's gas export markets. However, this option seems unlikely and would still require interconnection agreement between Ukrainian TSO and Gazprom, regardless of the origin of gas. Now, second option could be delivering Azerbaijani volumes via the southern route of Ukraine. However, again, the pipeline capacity along this route is limited, and given the distance, the transportation costs are economically unviable. Most importantly, this option would require significant additional gas supplies from Azerbaijan, which currently covers only domestic needs and existing export commitments.
OK, so there's a number of question marks then that need to be addressed if Azerbaijan is to come forward with that potential additional supply. What is all of this doing to gas prices then?
I would say that this uncertainty could trigger gas price spikes, especially towards the end of the year, as markets remain sensitive to any supply losses. For instance, we've seen in May when European gas prices jumped over 10% when Austria's company OMV announced that potentially their Russian gas imports could be halted due to the court ruling that could force the company to divert its payment from Gazprom to another European energy company. However, besides this Russian gas transit uncertainty, there are plenty of other risks on the market, such as geopolitical instability in the Middle East.
OK, really smart analysis and giving us a much clearer picture of what could transpire in terms of the European gas picture as we lead up to the winter then. Irina Sereda, head of Bloomberg NEF's European gas team, on some of the challenges facing the continent and potential volatility around prices. Thank you for the details. Coming up, we're going to continue a conversation in terms of the energy space. We're going to bring in Carole Nakhle, the founder and CEO of Crystol Energy, on the oil price and what to expect as those geopolitical tensions around the Middle East remain, of course, in focus. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Markets rebound. Asian stocks are mostly higher, but US futures are in the red despite encouraging data out of the US and China. The Fed's Tom Barkin says the central bank has time to wait before acting more forcefully. Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy. He and Kamala Harris agreed to debate in September. And oil set to close the week higher as the US, Qatar and Egypt call for a new round of ceasefire talks between Israel and Hamas. And we'll do a deep dive, of course, on the oil markets in just the next couple of minutes. But we'll check more broadly on these markets then. After a strong day for US equities yesterday, the S&P notching its best day since November 2022. NASDAQ as well, ending higher by 3%. But some of those gains have been given up in the futures so far in the session. And it's pointing to a muted start to your Friday trading session here in Europe, with the European stocks 50 futures pointing higher by just 0.1%. Here in the UK, the FTSE 100 looking to add 11 points. S&P E-minis pointing down by 0.1%, and NASDAQ futures taking a breather as well, looking to losses of around 17 points, just very modestly lower by 0.1%. Again, after a very strong session yesterday for that tech-heavy index. Let's flip the board and look cross asset. We had a 30-year Treasury auction yesterday out of the US, not particularly well received by the markets. Treasury markets, though, are relatively balanced in the session today after jobless claims came in better than expected, fewer jobless claims. That gave some relief for equities and a bit of a sell-off for the bond markets, 4% on the 2-year currently. The Japanese yen, a little bit of strength coming through, but broadly for the week, of course, it has been softer. 146 on the currency, $79 a barrel on Brent, and Bitcoin back above 60,000, a gain of 2% in the session. Let's get to the Middle East then and the details there, as the US, Qatar and Egypt are calling for a new round of ceasefire talks next week between Israel and Hamas. It comes as American F-22 fighter jets arrive in the Middle East as the region braces for a possible retaliatory attack by Iran. Joining me now is Bloomberg Horizon's Middle East and Africa anchor, Jemana Pescetti. Jemana, what are the expectations then of reaching a ceasefire deal?
Well, good morning, Tom. It was a pretty strong statement put out by U.S. President, the Emir of Qatar, and the Egyptian President Sisi yesterday, all urging on both Israeli and Hamas officials to attend these ceasefire discussions next week to finalize the discussions that have been underway. Very strongly worded statement saying it is time immediately to put an end to the long-standing suffering of the people of the Gaza Strip, as well as the hostages and their families. It is time to finalize a ceasefire agreement and release the hostages and detainees. They also add that it is only the details of carrying out a ceasefire that remain to be negotiated. And we found out just a short while ago that Israel do intend to send a delegation on August the 15th. Nothing yet from Hamas, and it is, of course, still unclear who will be representing Hamas, given, as we were speaking about earlier this week, the appointment of Yahya Sinwar as the new political leader was deemed to be a bit of a shot in the arm for these ceasefire discussions, and was taken as a potential setback, given the fact that Yahya Sinwar was one of the masterminds of October 7 and is deemed to be from the more radical part of the party. But the fact that the U.S., Qatar and Egypt are pushing forward, and Israel do plan on sending a delegation, is positive in that regard. One other thing that I just want to add as well is even Iran, the new president Pezeshkian had a call with the French President Macron earlier this week, and he also said that in order to bring down the tension in the region, you would need to get this truce and the ceasefire deal across the line. And so there is a perception that in order for all of the temperature in the region to calm down, you would need to see it accompanied with a Gaza ceasefire.
And we've had this conversation so many times, haven't we, Jaman, about how close they are to a potential ceasefire. We get that proximity. We have the US officials coming out saying we think we're close to a deal, and then it gets caught up for whatever reason. And as you rightly say, many in the region pointing to the essential nature of the ceasefire deal to avoid that further escalation. What is the US doing to try and deter those potential attacks from Iran or its proxies?
The U.S. are pursuing a two-pronged approach here. On one hand, they are actively pushing for the diplomatic channels. They want to get the ceasefire discussions over the line. They want to get the deal finalized. But at the same time, they're also pursuing so-called strategic deterrence. And what I mean by that is they're sending more and more military assets to the region. Now, we know that the U.S. currently have about 40,000 personnel positioned in the region, scattered around various bases. They have very strong naval fleets. They have air bases in Qatar and Bahrain that we've spoken about. But in the past week or so, they've been sending more military assets. Yesterday, the Central Command said that they have sent F-22 fighter jets to the region that are very powerful in terms of detecting and surveying should there be that potentially Iranian retaliation that we've spoken about. They've also deployed more military warships and fighter planes as well. So on one hand, even though they're pushing the diplomatic angle, on the other hand, they are deploying more assets to the region to send a signal to Iran and its proxies that should the retaliation come, the U.S. would not hesitate to come to the defense of Israel, similar to what we saw back on April 13th with that direct tit-for-tat retaliation that took place between Iran and Israel directly, when you saw those coalition forces come in and intervene, intercept, and shoot down the drones that were fired at Tel Aviv at the time. So there is an expectation that the retaliation is coming and that the U.S. is getting itself ready to defend Israel.
OK, Bloomberg Horizons Middle East and Africa anchor Jemina Pasenchi with the latest out of the region. Thank you. Now, oil has steadied after a 3-day rebound, with traders monitoring, of course, those developments in the Middle East and a rally in wider markets. Joining us now for the details and a deep dive on the oil space is Carole Nakhle, founder and CEO of Crystol Energy, someone who has the finger firmly on the pulse of these oil and energy markets. Carole, thanks for joining us. How much geopolitical risk is priced into oil right now?
Well, it's interesting that the geopolitical risk premium kind of diminished when it comes to pricing crude oil and its derivatives, because you can see that there is no shortage of geopolitical problems and headaches around the world, including those involving the main players in oil markets. You don't forget that Russia, there is ongoing war in Ukraine, and Russia is an important producer and exporter and is the most sanctioned country. Then on top of that, you have what's happening in the Middle East, the potential retaliation of Iran towards Israel and what could happen in the region. The war in Gaza is still ongoing. Libya has shown some instability, Venezuela protests, Nigeria protests. So you name it, there is no shortage of geopolitical tensions. And yet when you look at the oil price, it feels that the oil market is kind of turning a blind eye to all these developments, for the main reason that, first of all, there are fears but not really supply disruptions. And even those fears have to take into consideration how much spare capacity there is in the system. And actually, thanks to OPEC Plus cuts over the last few years, we have substantial, above 5-year average spare capacity in the system, and that by itself dampens the geopolitical risk premium. By the way, I have to say that nobody really knows how much value to put on the geopolitical risk premium, but it's not seen in isolation from the broader market conditions, and the market itself is not quite tight globally, as prices are telling us.
Well, and part of that lack of tightness will be focused on what's happening out of China. There's a number of different components, of course, in terms of the economic impulses out there. But China is still not where many had expected in terms of that demand. What are you seeing in terms of the demand impulse out of China, and what, in fact, their inventories are looking like?
China, and all eyes are on China because it is the largest oil importer in the world, and it is the second largest economy in the world after the U.S. So the significance of China to the global economy has, and also to oil markets in particular, cannot be underestimated. And so far, yes, people underestimated actually the potential structural problems with the Chinese economy. And these have been unfolding since at least the beginning of the year. Actually, over the last year, we started seeing some significant structural problems that are unlikely to dissipate anytime soon. We see growth, but it's not as expected and not in line with the growth that we saw, for example, before COVID. And actually, oil imports, crude imports to China have eased in July, and that by itself is sending negative signals to global oil markets. And by the way, the IEA and OPEC, despite their divergences in recent months in particular and this year, they both put great emphasis on China as being the growth engine for oil demand this year. And actually, they might well be both wrong. We're going to see. But so far, the news from China is not terribly encouraging when it comes to the economic growth and by itself with implications on oil demand growth.
Yeah, in your notes to us, you talk about the IEA and OPEC and their research teams being on essentially different planets when it comes to their outlooks. Apart from that question of China, which of course you question, when it comes to the US, then we talk about the economic growth, the economic fundamentals, all sorts of scrutiny, of course, in terms of risks around a US recession. Are we seeing that playing out in these oil markets, particularly and at a time when oil demand is expected to tick up in the US during that key summer season?
Definitely. We would expect during the summer season, because people are traveling more, they are driving more, to see an uptick in oil demand. And we are seeing some of that, but it's not really as strong as we would have expected for this time of the year. And what happened to oil markets over the last few days and earlier this week when oil prices reached their lowest in 8 months, And that by itself tells you how delicate the situation is and how the strength in demand, wherever it is coming from, is not strong enough to dissipate fears of a slower economic growth. And even if you look at major financial institutions, they are now allocating a higher probability for a potential maybe recession scenario in the U.S. It may be unlikely to happen, but that fear, that scenario is being now more considered than before because of the economic data. The job market data has not been as strong as many have hoped for.
What is the OPEC Plus response at this point, do you think, Carole? What are we looking for them?
Well, look, as long as they are sticking to their own forecast for oil demand, which are the most optimistic among all market observers for this year, I don't think they are going to change their policies or their decisions in terms of starting to relax some of their voluntary cuts as of the fourth quarter of this year. So only if they really go back and they change their forecast for oil demand or something on the geopolitical scene changes drastically, I would expect them to remain loyal to the decisions that they took in recent months.
Is this where the pricing stays at around this $80, just shy of $80 a barrel on Brent? I get the sense from you that you're cautious in terms of the demand picture. You're questioning China's role. As we lead up to the end of the year, what are you looking at in terms of pricing?
I don't think we're going to see a major change from the current corridor that we have seen, like the 75 to 80. I don't like to make forecasts about oil prices because, ironically, none of the forecasts have been accurate. It's like we are more accurate in predicting the weather than oil prices, as we always joke. But so far, under existing market conditions, from the economic data, whether from the U.S. and particularly from China, we forgot to talk about the supply growth outside OPEC Plus, which is healthy for this year. Also, don't forget there's a geopolitical risk premium which has dampened, but there are also elections that might change the outcome, particularly in the U.S. by the end of this year. But on balance, if I look at the main fundamentals, I don't see oil prices moving away from this corridor between 75 and 80. And I bet you tomorrow I will be proven wrong.
OK, well, it's also always smart analysis on these oil markets. Carole Nakhle of Crystol Energy there, with the caveats around that view on $75 to $80 barrel oil on the current fundamentals, the current conditions, of course, for those energy markets. Carole, always smart. Thank you very much. Now to some other stories making news this Friday. Eli Lilly closing the gap with rival Novo Nordisk in the race to dominate the obesity market as it expands its supplies of weight loss drugs. Lilly reported $1.2 billion in second quarter sales of Zepbound, smashing Wall Street's estimates of $819 million. It now expects full year revenue of up to $46.6 billion, up from its earlier guidance of around $44 billion. Paramount Global jumped in late US trade after taking a second quarter impairment charge of $6 billion on its cable networks, the latest sign of weakness in the traditional TV industry. The parent of Nickelodeon and MTV says it's because of declining profit projections and the recently agreed merger with Skydance Media. Earlier this week, Warner Brothers Discovery announced a $9 billion write-down on its cable networks, including CNN and TNT. Here's what else to look out for this coming week then. On Sunday, the Paris Olympics closing ceremony. And OPEC Plus, we've been talking about OPEC. August oil market report is coming out, so we'll get details in terms of their projections on the demand and supply picture. Again, just hearing there from Carole Nakhle on the view that you're going to be stuck in this range, probably of between $75 to $80 a barrel on Brent, with all the caveats implied as well. And we're going to be getting traffic figures from Heathrow over that key summer travel period, the summer holidays in July. That's going to come through on Tuesday. It'll give us a sense as to how much demand there is for these airlines, of course. And the unemployment data out of the UK as we continue to build expectations on the BOE's next steps. The German ZEW survey comes out on Wednesday. We'll see if there's any signs of a turnaround in the relative softness, of course, of Europe's largest economy. And on the earnings front, it's a big one when it comes to the financials, banks in focus, with UBS earnings coming out on Wednesday. We also got inflation data out of the UK, tying into that BOE story, of course. A big week in terms of inflation data out of the US and the UK. The UK print on Wednesday. And on Thursday, earnings from Walmart, Alibaba, JD.com as well. And India's Prime Minister Narendra Modi will give his first speech of his third term. On Friday, University of Michigan, that August consumer sentiment survey, so a sense as to the health of the US consumer, and retail sales as well. Coming up, Trump questions Fed independence, not for the first time, saying presidents should have some say on monetary policy. More details on what we've been hearing from the former president next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Republican presidential nominee Donald Trump told reporters the president should have some say over US interest rates and monetary policy. Such a move would go against the long-standing practice, of course, of keeping the Fed independent from political actors. Trump has repeatedly complained about the issue and criticised Fed Chair Jerome Powell, who he appointed, for being both a bit too early and too late on moving interest rates.
I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Trump also pitched a series of debates with Kamala Harris in September. His team is offering debates on Fox, NBC and ABC. The Harris campaign says it's happy to have a conversation about additional debates beyond the one they'd already agreed to. However, according to a campaign official, Harris will not agree to the Fox News debate. Speaking with reporters at Mar-a-Lago, Trump criticised Harris for avoiding media interviews since securing that nomination.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
Meanwhile, Kamala Harris did speak with reporters about those debates.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
And with the Democratic Party's nomination sewn up and running mate Governor Tim Walz of Minnesota at her side, Vice President Kamala Harris is experiencing a groundswell of support, having raised a record $200 million in campaign donations in less than a week. The daughter of black and South Asian parents, she would represent a series of firsts, of course, for America if she wins. Polls show voters, particularly in those swing states, reacting positively to her candidacy. But one of the big variables through November will be, as always, the U.S. economy.
I am now officially the Democratic nominee.
We're in Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that and they're like, oh my gosh, this could actually happen and I could be a part of it.
And you can read more of our Big Take story on swing states online at Bloomberg.com or, of course, on your Bloomberg terminal. Plenty more coming up. Stay with us. This is Bloomberg.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession.
In fact, they've just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run on the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend, and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along, and we probably won't see a recession.
Okay, executives there giving their views on the recession risks around the US. We had, of course, Fed officials coming out overnight as well, notably Tom Barkin suggesting that the Fed does have time still to assess the data before they make any moves. But what a week it's been in terms of repricing around the Fed. You take yourself back to Monday and expectations of a 60% chance of an emergency cut from the Fed before their next meeting in September. That has been faded. But look at the moves that you've seen in terms of the blowout, in terms of the expectations around where and to what extent they cut. So expectations, 40 basis points coming through for September. The next meeting, then, that's the white line, by the way, September. The next meeting would be in November. Expectations, 30 points there in terms of the cuts. And then you've got the final month for this Fed, December, and expectations of 31 basis points. In total, about 100 basis points still priced in terms of cuts. 3 cuts expected in September, November and December. That's the pricing as things stand. Of course, that could adjust next week when we get the inflation data out of the US. Let's flip the board and see how this has all impacted, of course, the stock markets, because you did see it's notable in terms of the demand that you saw for US equities yesterday after the rout on Monday. You did see the S&P notching its best day since November of 2022. Futures looking a little soggy in the session so far as we build up, of course, to the open here in Europe. But it was a big day for US stocks, buying the dip, it seems, but taking it of a breather, at least so far, according to, and if you look at US futures. Let's flip the board and have a look at Bitcoin as well, because that rallied as well yesterday after a drop of 10% on Monday. Bitcoin rallying yesterday, back above 60,000, still about 14% lower than its March record high of 73,000, but getting a relief in terms of the risk assets out there on some of that softer jobs claims data. Stay with us, plenty more coming up, including, of course, the opening trade. This is Bloomberg.